Hey guys, Prof Sales coming at you with another episode of 10 at 10. So this is the series where every day at 10 a.m. Eastern Time, we come on for about 10 minutes or so, and we talk about various topics that apply to reselling and business. And today's topic is one that's near and dear to my heart: profit or loss. Are you making any money or not is a better way to look at this. So I thought what it would be good to do is kind of walk you through just a few major concepts here in terms of profit or loss and what you should think about. So let's get right to it. The first thing we're going to talk about is this concept of revenue. Revenue. So I'm going to give you a definition, a good definition for this. The amount the amount of money your business makes from its activities. Real simple, right? Just the amount of money you make from your business. Now, this could be the amount of money over a week, a month, a year, a quarter, whatever kind of time frame you want. It really doesn't matter. So let's talk about two types of it. There's operating and non-operating. So the operating revenue is just money that you would make from your core business. So if you're a reseller, this is what you're making from selling the items that you've gone out and you've found. Non-operating would be kind of the one-offs that could happen every once in a while. Maybe you sell an asset, maybe you sell a printer you use in your business or a desk, and you would record that revenue. Kind of unusual, but I wanted to throw it in there just in case you ever run into it. So here's why it matters, guys. Knowing your revenue for a given period of time allows you to track your results. Okay, so you can say, if I've had this much revenue, if I had $4,000 in March, and then I had $5,000, I made $5,000 in April in revenue, I know my revenue is on the upswing. As a matter of fact, if we take the difference between those, $1,000 is the difference, 5,000 minus 4,000, and divided by that, 1,000 divided by 4,000 gives us a 25% increase. So we could say that our revenues in April increased by 25%, which may or may not be good. On the surface, it probably looks pretty good, but there's more to this story, so let's talk about it. Next topic, one of my favorites. And I'm going to erase this so we have plenty of room to see and write. Cost of goods sold. So let me spell that out. Cost of goods sold. Now, this one gets thrown around a lot, and it's used incorrectly a lot. And here's why I'm going to say that. So this is basically the direct cost attributable to your sales. All right. Now here's where people get tripped up on this. Let's say you go buy a $5 item and it's sitting there, and you list it somewhere and you list it for 20 bucks. All right. Or whatever your amount is, doesn't matter. That item is not a cost of goods sold. It's actually considered inventory. It's an asset of the business at that moment. Once you sell it, it becomes a cost of goods sold, okay? Now, some people use those interchangeably, but they're really not the same. So if you bought a whole bunch of items and then you sell some percentage of them, the amount that you spent for the ones you sold, that would be your cost of goods figure. So let's examine why this is important. I'm going to give you a good example here. Let's say you buy a shirt for $3. and you sell it for 12, okay? So you 4x your money. 3 goes into 12 4 times. So that gives us what we can kind of look at a percentage there to determine what our cost of goods percentage was for that item. So if we take 3 and divide it by 12, we get 25%. So our cost of goods sold percentage for that item was 25%. 25% of what our revenue was on that item we spent to buy the item. Now let's compare it to, say, a pair of jeans. And we'll say we bought these for $5. And we'll say we sell them for 22, right? If we divide 5 by 22, we get 22.7%. So it cost us 2.3% less for the jeans, even though they cost more than the shirt. Now, so you could argue, well, this is a lower percentage of my sales to buy this type of item. And of course, I sell a lot of jeans, so maybe I'm a little biased here. But on the flip side of this argument, you could argue, well, I can buy a lot more $3 shirts than I can $5 jeans, right? If you bought 10 shirts, it would cost you 30 bucks. If you bought 10 jeans, it cost you 50 bucks. So you're going to spend more for these, sell them at a higher price and at a lower cost of goods sold percentage, but it's going to cost you more upfront to acquire that inventory. But that's what you can use cost of goods sold to tell you. And it's very simple to figure. You just take the cost you paid once it sells and divide it by the total amount you receive for it. And that's going to give you this percentage. Hopefully that makes sense. So we're going to keep moving on with this. So we've got our cost of goods, we got our revenue. So now we need to figure out something else. You're going to hear this term thrown around in reselling a lot too. Gross profit. All right? It's not complicated. So I'm going to give you a very simple formula for it. GP equals revenue minus your cost of goods sold. That's it. And you're just going to get a figure here. So let me give you an example. So let's say that your revenue for April, we'll just say, was $5,000. Your cost of goods was $3,000. Excuse me, that's not the right number. Let's make that 2,000. So your gross profit, if you subtract these, is $3,000. Real simple. That's your gross profit for April. You take everything you sold and subtract what your direct cost was for selling. Basically what you paid for the items you sold if you're a reseller. Very simple. So what can you use this for? You can do it for something called the gross margin. Now all this is very simple. You take this number and divide it by your total revenue, and you get 60%. So your gross margin percentage for April, in this example, is 60%. So you might say, again, is that good, Prof? Is that bad, Prof? Well, it depends, right? It's going to depend on a couple other things, but again, you could track this. You can look at this each month, each week, each year, each quarter, whatever you want to look at. And businesses do this. They track and say, all right, how is our gross margin doing? Because if your gross margin is not as high as you want, maybe you're not selling for enough money. Maybe your cost of goods is too high. And if you change those levers, like if you increase your pricing a little bit or reduce your sourcing cost, you can increase that percentage. So it gives you another tool. All right, so one of the least favorite topics, or at least I think it's the least favorite in reselling, but you got to know this one. Expenses. All right. These are not cost of goods sold. This is not what you pay for inventory. This is all the stuff that happens on the back end. So I'm going to give you a few examples I've got here. So we got office expense. We got fees and subscriptions. Maybe you have a store on eBay and you pay a monthly fee for that, a subscription fee. That's a business expense. You have your mileage expense. I'm not going to go into all the ways to track all these. You got your shipping supplies. You've got your equipment and probably a lot of other things. And these are all things that you use for your business, okay? So you've got all these things. So why do these matter? Because these are what's known as a variable cost. You can control some of this. You can control the amount of money you spend on office expenses or fees. You can control how much you drive. Now, you will have some tax breaks for that, but it's still an expense. Shipping supplies, you might be able to get free shipping supplies. Equipment, you might be able to find cheaper or even free equipment in some cases, or just use things a lot longer. It's a variable cost. It's kind of like your food bill. If you're in your personal life, you can control to some degree how much you spend on food by whether you eat out, whether you buy cheaper, what have you. So, and you could even track this as a percentage versus that revenue if you want. So let's put all this together, and I'm going to give you the final metric. And this is the best one, right? So Prof, we've bought all these items, we've sold them, we've spent some money to do it in terms of expenses. What are we making? Net profit. This is the end. So I'm going to give you a quick example here. Now, all this equals is revenue minus your cost of goods minus your expenses. Now, you might have tax liability in your business here. We're going to leave that out of this argument for the moment. But if you subtract those three things we just went through, you're going to get what you made in a given time frame. So let's give you a good example of that. Let's say that you made $5,000 and your cost of goods, we'll just keep the numbers the same, is $2,000. That's what you paid for all your stuff. So your gross profit is $3,000. Your expenses, we'll say for this particular month, were $1,000. And so what is your net profit? Equals $2,000. So before you pay any taxes and so on, this would be your net profit for this particular month. And we have something called a net profit margin. By the way, our gross margin is here, and it's 60%, which is 3,000 divided by 5,000. Yes, and our net margin is 40%, which represents 2,000 divided by 5,000. So we take our profit and divide it by our total revenue. Here we took our gross and divided by our revenue. So you had a 40% net margin for the month. So is that a good thing, a bad thing? You can tell, you can talk to other resellers, you can look at industry averages depending on what business you're in and decide, hey, that seems in line with them. Like if you're in the restaurant business, for instance, your net margin is probably a lot lower than that. They tend to have lower margins. On the other hand, other businesses might have even higher margins. And obviously you could do this for any particular item that you sell, because an item has revenue, a cost of goods, and then some expenses to sell it too, right? Those are a little bit tricky to figure in on average on just one item. So what I've just walked you through here, guys, is what's called a P&L, profit and loss statement, or sometimes called the income statement. It's a tool that you can use to track your business on a weekly, monthly, quarterly, yearly basis. And it's something where you can tell how your business fluctuates over time, and you can press certain levers to improve it. You can try to increase revenue, maybe through pricing, maybe through listing more items. You can try to lower your cost of goods sold through maybe finding cheaper sources of supply, moving to different markets. You can try keep your expenses in control by not spending any more than you absolutely have to. So you've got all different ways here you can improve this bottom line number. And because here's what's going to happen, because next month you might do $8,000 in sales, and your cost of goods might be $3,500, and your expenses might be $1,400. So on the surface of it, you can't just look and see whether or not you're making progress. You kind of have to figure out some of these ratios and see what the percentages, how they're moving and changing over a given time frame. And that's how any business does it, guys. Whether it's mom and pop store or Walmart or Amazon, doesn't matter. They all do this. Now, their statements are a little more complicated, a little more broken out, but at the end of the day, it still comes down to your revenue minus the cost of goods to do it, minus your expenses equals your net profit. So I hope that that was helpful, guys. All right, 3 things. If you like this video, leave me a comment down below. Smash the like button, as Karin likes to say. Also, check out the associates links in the description in this video. You can find all of our equipment that we use, as well as this cool Prof Mass shirt, if you can be the first one on your block. And you know, just let me know, guys, how this video did for you. Let me know if you liked it, if you thought it was helpful, and if you want to see more like this. We're going to keep doing these 10 to 10s for a while, and we'll see you on the next one Monday next week. Take care, guys. Good sales to you.